So, buyers, do you know what's happening out there? We have a massive uptick in demand, which is causing prices to spike, and we are seeing multiple offers, 25 to $100,000 over asking. And this isn't just the $1 million homes; it's the $600,000 and $500,000 homes. It really is mind blowing. Well, I want to talk about at the end of this live how I think you need to prepare and what's leading up to all of this demand. So let's start with what's happening in the market right now. I want to do a quick update on the banks. We're all done. I'm done hearing about the banks. I get it, but it's a thing. It's a real thing, especially if you banked in one of these banks. And I know a lot of mortgage companies banked at a lot of these banks. So I know that a lot of companies were quickly figuring out where their warehouse lines were, where their assets were, and reallocating or redistributing where those assets were held. And I know a lot of depositors were doing the same thing. But interestingly enough, unlike very old run on banks, we are not seeing depositors pull their cash out and put it under their mattress. We're actually just seeing deposits pulled from banks at risk and put into other banks. So Chase and Wells and Bank of America all saw a major uptick in deposits. Interestingly, as that sounds, it really just states the safety of the market. When people pull their cash out, put it under their mattress, not good. When people just simply move it from one choice to another, that is what you'd call a safe banking environment, giving Americans choices to put their money where they feel it is most safe. So that is what was happening. But we've got this drifting away from panic happening right now. So the market is rebounding a little bit. So we actually just heard that UBS bought Credit Suisse. We also saw First Republic stock jumped 20% this morning. So we're seeing a return towards stability. And whenever you see a return towards stability, you are going to see interest rates start to flatten and not have these massive swings again. And when we saw the banks, I want to go backwards just for a minute. When we saw this massive panic happening with the banks, we saw people pulling their money out of stocks and putting it into bonds, mostly short-term bonds. When you pull money out of stocks and you put it into bonds, and that's called a flight to safety, equities are going to go down, which we saw. A lot of us lost money in the stocks. The whole stock market took a beating, but certainly the banking stocks particularly took a beating. People pull their money out of stocks and they put it in the safety of bonds. Bonds are one of your most safe investments. They also provide the least income. So putting your money into the bonds creates a higher demand on bonds, which increases their prices. Think about it. If you have multiple bids on a house, that house price is going to go up. Same thing happens with bonds. I have multiple people trying to buy the bonds. The bond prices go up. Inversely, the yield, the interest rate goes down. So we saw that. We saw interest rates drop and drop dramatically with each one of these pops of news on each one of the banks that were having issues, right from the very beginning, in the middle of last week through most recently. So all of that creating a drop in interest rate and benefiting our buyers. We saw mortgage purchase applications go up 2 weeks in a row, 7% each week, taking advantage of some of these quick drops in interest rate. Because as crazy as the banking market seems, and it's garnering a lot of attention in the news, a lot of employees, as we know, there are almost 2 jobs per unemployment person, and we're still seeing wage increases. We are seeing a lot of job stability, even though the economy as a whole is slowing down. That job security, albeit maybe not in IT or banking, is prevalent in all of the other markets. So when you're talking about home buyers, many buyers are not impacted by what's happening in the banking world. And they're certainly not impacted by what's happening in real estate. When the real estate lenders and realtors had maybe their worst quarter ever, fourth quarter of 2022. Other industries were not feeling that pain. So we have to think more globally instead of locally. So when we talk about whether it's a pain in the banking industry, a pain in the real estate market, a lot of industries and those jobs increasing in wages, and those employees continue to feel safe and secure outside of where maybe they hold their deposits. If they're feeling safe and secure and they see that those interest rates have dropped, even momentarily, they're going to jump on those opportunities to secure a home. Now, on top of that, we have seasonality. It's the spring buying season. You have a lot of people who want to get in front of having their family in their home by summer when school is either out or maybe they're just starting to look. It typically can happen after Super Bowl. In the old, it used to happen more after spring break, which is happening right now. We already started to see this earlier in the year. So we have these buyers continuing to come out. So let's go back to what's happening in the market right now, though, with interest rates and how that's going to impact the buyers who are going out and feeling safe in their jobs and looking to purchase a home. So right now we're seeing a stability in the interest rates. We are actually trading in the 10-year very close to 3.5. Over the last 5 days, we fell into a range. And that range is happening because as people are not feeling as fearful, because President Biden came out saying that we're going to save all the depositors. And of course, we know that we're all ramping up towards the information tomorrow with Fed Chair Powell speaking. But as the banks go, other banks are rallying around and purchasing them. I mean, look at UBS and Credit Suisse, and we saw that with the other banks as well. So if other banks and or the FDIC is coming in and saving banks, and we saw them collapse and we saw the market rally around and we saw the FDIC save and we saw other banks come in, all of those things happening, now all of a sudden you have investors who feel confident and comfortable going back into the stock market. So they're like, that wasn't so bad, right? Like we felt it, we did the thing, we got all scared, we moved over to bonds, now we're feeling safe again. I'm making money in other stocks. There's other companies doing especially well. And I'm going to put my money back at a little bit of risk, more return. I'm going to put it back in the stock market. As people sell bonds, then you see the prices go down and the yields or the interest rates go back up again. Now, this is happening right here. It's in a range. So we're finding a little bit of stability. With all of that, we are looking towards Powell, who's going to make the next move in our markets and in interest rates. Powell speaks tomorrow. The meeting started today. There's a lot of people guessing. All you can do is guess. We have the dot plot that's coming out after this meeting that's going to tell you what the Fed members believe they want to see over the next couple of years. We'll be talking about that on Thursday's market update. You also have economists who are pouring into the Fed's futures that are talking about where do we think the Fed rate is going to go. Now for tomorrow, it is very likely that the Fed is going to raise the Fed rate a quarter. A lot of people want to see them go zero. They want to see it flat. And it's a little over 50%, closer to 55, 60% of people think that they're going to raise it a quarter, a little closer to the 40% mark of people that think that they're going to leave it flat. Either way, the market is already starting to adjust for this. And this is well off the 50 bip hike that we were talking about and thinking was going to happen before the bank failures. So if we see a quarter, it could keep our interest rates relatively stable. Now, it's the Fed futures and the dot plot that we're really looking at on this meeting. Of course, it's Fed Chair Powell's comments, but that dot plot is going to give you an insight into where the Fed board members want to see that Fed rate. There is a lot of assumptions going on right now that we might see the Fed rate drop by a full percentage point before the end of the year. Now I'm going to flash back to you and say that's what people were thinking at the end of 2022, which is why we saw the rates drop the way that we did, because the market moves on expectation, not on reality. The market moved based on the fact that we thought that the Fed was going to drop the Fed rate, which means that inflation is under somewhat of control. And when inflation goes down, interest rates go down. So if the Fed is dropping the Fed rate, it means that we've controlled inflation, which means the interest rates can come down and people can start spending again. The whole reason the Fed raises the Fed rate is to increase the cost of everything. And when you increase the cost, not of everything, let me rephrase that, increase the cost of borrowing for everything, right? So that you stop spending on everything. So if the increase of cost of borrowing, whether that's the credit card interest rates, your HELOC interest rates, your short-term loan interest rates, your bank-to-bank rates, whatever those interest rates are, they raise the Fed rate to slow down spending, to let inflation slow down, which is just simply a supply and demand metric allowing interest rates to come down. So if the Fed futures think that we're going to see a point decrease later this year, that means that we're going to already start to see a little bit of that. We might even see interest rates drop based on the Fed dot plots, or certainly within the next couple months. And if we do see those rates drop in the second half of the year, it's going to mean what? It's going to mean the interest rates are going to come down because we've controlled inflation. It's going to mean that buyers today are going to have opportunity to refinance. It's going to mean those buyers who are sitting on the sideline waiting for low interest rates are going to come out. A lot of experts, housing experts, are already saying that we're going to have a stronger second half than first half. Now, we all know that forecasts are only worth the paper they're written on. But I will tell you this, that forecasts change behavior. And the behavior of the buyer today is showing that change. Buyers are out right now, eager to get under contract. They're willing to put their money where their mouth is. Those homes that are staged right and priced right, it has never been more important to work with an expert real estate agent. I promise you that. Those homes that are priced right and staged right are selling quickly within days. And they're selling for $25,000, $50,000, $100,000, $150,000 over asking. While those which are not priced right, staged right, a little consideration up front, they're sitting on the market and they're seeing price reductions. And they're going longer days on market. And with that, they are not getting the attention of the buyers today, the hungry buyers who are also assuming that in the second half of this year, interest rates are going to go down. So I'm going to grab a home today before the massive demand, the second half of this year comes out and upbids that home even further. I want to grab that home today. I want to start having it make money for me and I can refinance later. Right? It's a confidence. A confidence in my purchase today is aligning with both what I need as a human and where I live and the safety and stability, as well as what I need financially procuring a lower interest rate the back half of this year. That confidence in where we're headed, that we're getting there, that we've taken care of the banks, that we've seen the FDIC step in, we've seen President Biden step in, we've seen other banks step in. Nobody loves a bank failure. Nobody loves a bank failure. I'm not going to sit here and say it's all roses and everything's perfect because we literally just had like 5 bank failures. But I'm telling you that the market is protecting those bank failures and it's giving confidence to those buyers who are not in the banking industry, who have jobs, who are secure, and they're looking to purchase. Those buyers who understand the market are getting in now. Because here's the flip side of that. When the interest rates do drop, because remember, a majority of those homes, so almost 40% of all homes don't even have a mortgage, and the majority of the 60% that do, 62% that do, are locked in under 5%. When the interest rates drop below 5, which experts believe will happen in 2024, unless the Fed futures is right and we actually see the Fed drop the Fed rate a full point the second half of this year, then it'll happen in the second half of this year. I'm not telling you it absolutely will, but I'm telling you it will happen soon. And when that happens, those sellers who feel locked in will become sellers and buyers. Now it will create a little more inventory, but it's also going to put more buyers in the market because a lot of those sellers, I don't care what the interest rate drops to, they're locked in at a 2 and a 3. They're going to convert that home into a rental. They certainly are if they know me. So they're going to convert that home into a rental that's going to hold on to the inventory. They're not building enough homes that's going to hold on to the inventory. We're seeing housing starts for rent actually more than for purchase, meaning builders are building for investors who are building literally neighborhoods to rent. That's going to put a hold on inventory. Bezos and Amazon is crowdsourced funding investments in single family homes. That's going to put a hold on inventory. Those sellers who are waiting might give us a little bit of inventory, and people always move, right? People have babies, people get divorced, people get married, people graduate, people move for their job. People will always move, but not to the extent that we saw the last couple of years, and not to the extent that we have buyers anxiously waiting. The highest age group today is still on the precipice of the historic average age of a first-time home buyer. The highest age group today is 33. The average first-time home buyer is 34. You have massive demand who was priced out, then feared out, that is eager to go in. And they have confidence that the interest rates are going to go down. And if I get in now before that happens, my home price will continue to go up as more demand comes on the market, feeds unlimited inventory, holding up home prices. And anybody that's talking about a bubble is not looking at the massive lack of inventory we have right now. We have less than 1 million homes nationwide with 330 million people. You can't make this stuff up. So here's my plea to buyers, and this is what you need to do. Buyers, you need to get pre-approved with a lender that knows how to read the market, i.e. me. You need to get all of your ducks in a row. You need to have your documents scoured and you're ready. And if you are self-employed and you are getting ready to turn in your tax returns, you need to have me look at them first. Obviously, I am not a CPA, but I can tell you what you qualify for based on the draft. And then you can work with your CPA on whether or not you want to adjust any of your expenses. If you want to qualify for a home, a little pre-work goes a very long way. You might have credit issues that you don't even know about. We have free credit repair or free credit optimization. I have a great credit repair team too. We also have strategies and can design the journey and the path that you need to get you into home ownership, because we will continue to see demand strong. We will continue to see limited inventory, and those who know how to read the market and are watching what the Fed futures are doing and what the economy is doing and how the market and industry rallied around those banks knows. They know that we will control inflation and those interest rates will drop, and the people that get in now, while others are scared, will get, even if they pay over asking, will get a good home that will continue to increase in value, and they can always refinance. That's the game plan that buyers need to know about today. Nicole Rueth with the Rueth team. I hope you guys are having a fantastic day or a fantastic rest of your week. Please, if nothing else, let's get on the phone. Let's make your plan and let's go to work. Talk to you soon.